Hi, I'm Jeff Marcus with Hedge Maven. Today I'm going to be interviewing Mike Johannes. He is the Quantitative Research Director and Portfolio Manager for the O'Brien Investment Group. Welcome, Mike.
Thanks, it's great to be here.
In simple terms, what does your quant strategy entail?
Our quantitative strategy combines directional, systematic futures trading models with a suite of options trading strategies. The easiest way to understand it, I think, is via an example. Take a market like natural gas. Natural gas is a highly volatile market, but occasionally there's large, extended price movements, often in response to weather shocks. You get a cold snap, natural gas prices shoot higher. Our directional models naturally are often long natural gas futures prices in these market conditions. However, these market conditions also come along with extremely high market volatility. That has a number of effects. On the negative side, it reduces the signal strength, so we're less sure of the future direction when market volatility is high. It also increases our risk because we're holding futures positions in a highly volatile market. On the other hand, options markets, when natural gas prices shoot higher, are extremely expensive, and there's large volatility risk premium built into the natural gas options market. All else equal, you'd like to write call options on natural gas, but that's very risky because natural gas prices could continue to go up. However, we're long natural gas through our directional futures trading strategies, which means for us, writing options in this market not only allows us to capture volatility risk premia, it allows us to reduce our risk, and it buys us time in that we don't have to be in and out, we can wait. And that generates a lot of carry for the portfolio and allows us to smooth out our returns in an environment that all else equal wouldn't necessarily be that good for our strategy. And so options really provide a great complement to the futures trading book.
There's a lot in the quant literature that talks about the markets being efficient. What do you think?
Well, I do think markets are efficient, but I don't think markets are fully efficient. And what that means is there are times when you have an ability to predict prices with reasonable confidence. And the literature, although markets are efficient, that also doesn't mean there's not risk premia. And there are often very large risk premium, especially embedded in options markets, volatility and event risk premium. And our strategies are built to try and identify the periods where there is some predictability in the underlying futures markets and where there are large risk premia and event risk premia built into the options markets.
If you're looking to capture trends, isn't that the same as buy and hold?
No, not necessarily, and not in general. Our systematic strategies are trying to identify periods of heightened predictability, not just that markets tend to go up or down over time on average, but periods where we think there's an elevated degree of predictability. And in those situations, we'll be taking either long or short directional positions to try to capture that predictability.
How does your model make investment decisions in a highly event-driven environment?
Events can be very challenging. You know, we're used to seeing normal fluctuations in markets, and there are increasingly discrete events which can dislocate markets and create problems both for signals and for risk management. So take as an example a Federal Reserve meeting. It's at some level it's a one-off, it happens infrequently, it's not a normal type of event. We incorporate event-based strategies both on the futures side and on the options side, and in fact it's a critical feature of what we do. In particular, events may not be visible based on past historical data, options markets are forward-looking and contain a lot of information about the importance of future events. We have strategies around events, things like central banks, unemployment reports, OPEC ministers' meetings, to give a few examples. And the signals are triggered on both sides, both on the futures and options. And importantly, options markets often embed very large event risk premia, which a lot of our strategies, our options strategies, are designed to harvest.
What do you think is the most challenging environment for systematic trading?
The most challenging environment, at least for our strategies, is markets that are very episodic. Markets where you have very low volatility and then very quickly change to very high volatility. And the reason is the quality of the signals is going to be changing very quickly. We deal with those markets with strategies that work both in low volatility environments, high volatility environments, and with option strategies that do well when markets transition from, say, a low volatility to a high volatility environment, much like the markets we've seen the last few weeks based on the coronavirus.
Now, can you give us an example of where you think the models worked like a charm?
Sure, and I think probably the best example is a recent one. In the first part of 2020, global bond markets have been trending upwards, and they trended upwards at first with very low volatility. And so our directional futures signals were long global bond markets and long quite a bit of global bond markets. As markets have continued to move, volatilities have increased, and our option-based strategies have triggered, and we're selling call options into this environment. So it's a market where we had large directional movements, which our futures models were able to capitalize, and then when we got into an elevated volatility state, we've been able to write options on those positions, which reduces our risks, allows us to capture large volatility risk premium embedded in options, and also allows us to deal with the fact that our signal strength has been reduced given the really extended moves and high market volatility.
Give us an example of when you've seen the hurdles of a model-driven investment strategy.
It's a good question. I think the main hurdle is when market conditions are behaving in a way that are not captured by your model, or there's events in the market which your models were not built to capture. A great example of that is Brexit. Brexit is an event that never happened before. It'll probably never happen again. It's very large, but it's also binary. It's going to go one way or the other. And a lot of quantitative strategies weren't developed to deal with events like this. This is less of an issue for us because a lot of our strategies are based on options. Options are forward-looking, and options see the fact that Brexit's coming. And so for us, these are not necessarily a problem because even though they're forward-looking and even though they haven't happened before, the options markets see this event coming, and therefore we're able to trade through our option strategies, events like Brexit or other things like elections.
Why do you think the systematic trading community used to deliver better performance pre the 2008 crisis, particularly given the steep trends?
I think it's a combination of things. I think one, markets probably are on the margin more efficient than they used to be. I think there's a lot more money trading quantitative strategies, and I think we often have kind of everybody in, everybody out. And I think the third factor is that events, especially policy events, have become far more important. So you get large, extended moves in one direction, and you have policymakers who come in with almost an explicit goal of reversing those. So you can think of Mario Draghi's whatever it takes, reversing the massive move in the euro and in equity and bond markets at a policy event. And so the combination of those factors have led to deteriorated performance, at least from many traditional strategies.
What separates your trend following from the rest?
I think a number of things. First of all, we're not pure trend followers. So we have integrated strategies that trade futures and options. Many of our futures trading strategies are trend or momentum based. However, we're very active trading options. And so certainly trend following is a component of ours. We still believe that trends exist and you can monetize them. However, we think there's a better way to harvest those returns by trading options in addition to trading the underlying futures.
Why is now the time to invest in quantitative strategies?
I think there's a number of reasons. I think first of all, there's good quantitative strategies out there that provide good risk-adjusted, smooth returns in different economic environments. And also, I think in particular, the market environment right now is particularly well suited. We're seeing a market that at some level is very bimodal. You have very quiet markets, you have extremely volatile markets, and having systematic, quantitative, research-driven strategies that take out the human element really disciplines the investment process and should provide good, smooth, risk-adjusted returns through these periods of heightened market volatility.
Thanks, Mike.
Thank you.